Hi everyone! The past week on Wall Street was rather turbulent. Investors were assessing a batch of important macroeconomic reports that could potentially affect the Fed's key rate decision. Despite a noticeable decline in inflation, stock indices were unable to break through crucial levels. The S&P 500 was hovering above 4,130, yet it was a high upward potential. Although there were plenty of negative factors, benchmark stock indices ended the week with gains. On Monday, they managed to enter positive territory. However, initially, all three major stock indices were trading slightly below the zero line. This week, the economic calendar for the US is almost empty, but there will be some drivers that could trigger an upward movement. Tesla, Netflix, Bank of America, Morgan Stanley, and Johnson & Johnson will reveal their earnings reports. Apart from that, several Fed policymakers will deliver speeches. Enjoy the video review and leave your comments down below. Let's start. Last week, the US unveiled several inflation reports showing a slowdown in consumer prices. The core inflation was in line with forecasts. Services inflation eased more than predicted. The March figures indicated that inflation would cool down largely because of slowing services inflation. Curiously enough, market reaction was rather muted. After the release of inflation data, the yield of 10-year government bonds remained unchanged at 3.4%. However, the initial reaction was more or less positive. A bit later, the main stock indices showed a negative dynamic. There could be several reasons for this. Perhaps investors expected to see the CPI below the forecast reading. Besides, optimism faded away after the release of the Fed's meeting minutes. Concerns about the bank sector and comments about moderate recession at the end of this year undermined traders' hopes for a policy reversal in the near future. Wall Street closed in the red despite the fact that the previous meeting minutes indicated that some Fed officials spoke in favor of a soft stance. Following inflation data, the S&P climbed higher but faced the resistance level of 4,150 and rolled back. It continued to decline after the publication of the minutes. Investors remain cautious, carefully analyzing fresh data. They are looking for signs of economic stability despite the possibility of a recession. Naturally, the economy will hardly face a steep downturn, yet recent data has indicated that the economy is slowing down. The Fed is likely to raise the key rate in May. After that, the central bank may end the tightening cycle. Traders are now less dovish. However, some economists believe that the regulator could undertake 3 rate cuts until the end of the year. At the end of last week, the earnings season began. The profit results of the banks were in the limelight. Speculators analyzed them carefully before opening new positions. The earnings reports turned out to be quite upbeat. Strong quarterly results of the largest U.S. banks boosted market expectations of a 25 basis point rate hike in May. In addition, better than expected reports from JP Morgan, Citigroup, and Wells Fargo for the first quarter eased market concerns about recent woes in the banking sector. The Dow fell by more than 140 points on Friday, while S&P and NASDAQ lost 0.2 and 0.3% respectively. Of the week, the Dow rose by 1.4%, continuing its fourth-week winning streak. Stock indices climbed after the macro stats on slowing inflation and better-than-expected earnings reports from major central banks. Nevertheless, optimism remains subsided due to the uncertainty of the economic prospects and interest rates. The Fed is committed to taming inflation despite the risk of a moderate recession at the end of this year. Retail sales in March also beat economists' forecasts. Industrial production contracted more than expected as well. This is another sign of slowing economic expansion. However, in both cases, the readings for February were revised upwards. In general, the figures were not bad enough to somewhat force the Fed policymakers to consider a policy reversal. So the watchdog is likely to stick to aggressive tightening. This week, traders will study earnings reports of smaller banks that turned out to be at the epicenter of the banking crisis in March. On Tuesday and Wednesday, top banks such as Bank of America, Goldman Sachs, and Morgan Stanley will unveil their profit results. What's more, IBM, Netflix, and Tesla will also publish their quarterly reports. The S&P also rose by 1.5% last week. It consolidated above 4,130. However, it may reach 4,300. A new jump will confirm this forecast. About 6% of companies included in the S&P have already revealed their earnings results. According to FactSet, in the first quarter, adjusted earnings per share decreased by 6.5% on an annual basis. At the end of March, the indicator dropped by 6.7%. About 80 companies included in the index provided a negative revenue forecast, and more than 20 revealed a positive one. According to the results of the first and fourth quarters, the profits of companies from the S&P are likely to decline. However, the stock market has been growing in the last 2 quarters amid expectations of higher profits. Perhaps the fourth quarter of last year and the first quarter of the new year could be a bottom, and then the indicators will go up. Optimism is likely to prevail if companies provide relatively positive revenue forecasts by the end of the year. First of all, investors keep an eye on the semiconductor industry, where earnings results have been downbeat for some time. However, tech stocks have risen significantly since the start of the year. The heavy tech NASDAQ 100 climbed by 1.5% last week. The outlook remains bullish. The index may approach 13,600 as investors increase their long positions. However, the index will hardly grow above this level. After that, a downward correction and a new phase of consolidation may take place. If bulls push the index higher, it may face a resistance level of 14,270. Its further trajectory will mainly depend on fresh macro stats, namely building permits and new housing starts for March, existing home sales, and the manufacturing and services PMI indices. Reports published last week signaled the likelihood of a dovish stance in the near future. However, now investors are not so certain about such a scenario. They anticipate a policy reversal in the second half of the year. Yet, there is a chance that the Fed may keep rates high until 2024. On Friday, Fed Governor Christopher Waller acknowledged that the central bank has not made much progress in returning inflation to the 2% target. Hence, it needs to move interest rates higher. Atlanta Fed President Raphael Bostic made less hawkish comments, mentioning only one rate increase by a quarter point. It was not enough to calm markets, as Waller warned that the regulator would stick to a hawkish stance for a longer period of time. That is all for now. Subscribe to our channel and keep close tabs on market developments. See you!